So today we'll continue what we started last class, talking about the capital asset pricing model and what it implies for corporations buying insurance. Then we'll talk about what insurance companies can write, what's the nature of those risks, and then we'll get into the overall insurance industry and then specifically into the property and casualty insurance. So just a little bit of a rehash. We said the capital asset pricing model says that the risks that stockholders are worried about are systematic risks. Those that are tied to the overall economy, those systematic things like interest rates, major geopolitical events like COVID-19, commodity prices, inflation, but unsystematic risks that disappear when you have a diversified portfolio because they're company specific. So one company has bad news, another one's going to have good news, and so your portfolio is somewhat protected from that. And so the capital asset pricing model says management shouldn't be spending a whole lot of money trying to reduce unsystematic risk simply because the stock market's already eliminated that risk by diversifying their portfolio. So that brings up the question that we got into last time. Most of the risks covered by the insurance industry are unsystematic. Things like a fire at a warehouse, or theft, or pollution risk, or those kind of things. Not all, though. There are risks that are very systematic. Directors and officers insurance, when stockholders sue companies because they're upset the stock price came down and I think management made a mistake. Well, that's more likely to happen during a stock downturn than it is during a strong stock market. Or at least the number of claims will be higher after a bear market than after a bull market. Terrorism risk, COVID-19. We'll talk a little bit about COVID-19 and really if the insurance industry really insured that, but it definitely had some impact on the insurance industry. So the bulk of the risks covered by insurance are unsystematic. There are some, we talked last class about workers' comp being somewhat systematic and just the way the claims tend to be higher during recessions. But I'm going to argue that even if the risks covered by insurance are systematic, that it's theoretically still does not make sense for management to spend money eliminating these risks, and that comes down to what we call expense leakage. So there's two reasons stockholders are better off if companies don't buy insurance. Theoretically, again, that's really important. Theoretically, one, most of the risk unsystematic, so the stockholders can eliminate those risks themselves through diversification. However, let's talk about the systematic risk. All right, so what happens when a firm buys insurance in order to manage a systematic risk? So here's an example. I don't know why I used Toys R Us. I probably should have picked a company that wasn't going to go insolvent. So whatever company you want, it doesn't really matter who the company is. It could be JCPenney, Sears, any other company that's about to go insolvent, or any company that's strong, Walmart. So let's look at these two companies, and let's look at them first. This first section, let's say this is pre any kind of loss. All right, so this section is pre-loss. How are the companies doing? Well, Toys R Us has $1 billion in revenues, $800 million in expenses, and their net income is $200. Chubb is an insurance company. Chubb has $500 million in revenues, $400 million in expenses, and $100 million in net income. All right, so in the second scenario, let's say Toys R Us buys insurance. And they buy insurance on a $500 million warehouse. And that insurance costs them $50. So they spend $50 million for insurance, and their net income has gone from $200 million down to $150 million. Then Chubb, they get that as a premium, right? Their revenues went up $50 million. But also notice their expenses went up 20 million. Why did their expenses go up 20 million? Well, they have underwriting, they have policy service. So even without a claim, just writing the policy, just putting it on the books, all of that work is going to cost them some money. So that costs them 20. I'm just using a typical expense ratio for a company, about 20%. So that's going to cost them, or I guess it's probably a little high there. I probably shouldn't have used something quite that high, but 420, maybe it's more like 410, but 420. Chubb's not very efficient. And so their net income goes up, not 50 million, their net income goes up 130 million. So what has happened? Well, if this was your stock portfolio, so think of this as your stock portfolio, and you have these two stocks in your portfolio, the net income of your portfolio without any loss was 300 million. When Toys R Us buys insurance, their net income goes down 50 million. Chubb's goes up 30 million, but your overall portfolio's net income has dropped $20 million. And why is that? It's expense leakage. And on the exam, I'm a little picky about this because some students don't quite explain this the way and fully explain it. They just use the word expense leakage. That term is my own creation. So just saying expense leakage doesn't explain anything. So you have to explain it. For Chubb to put this insurer on the books, they have to expend $20 million in underwriting, policy service, those type of things. And so the net income of your portfolio comes down $20 million because Chubb has to put some time and effort in putting this insurance on the books. So you're actually harmed. Even without a loss, you're actually harmed. So the next question is, what happens if that $500 million warehouse burns down? So let's look at that. So maybe now's when you wish you had the insurance. All right, so what happens? So the same $1 billion in revenue, same 800 million, they spend 500 on the insurance. They lose 500 on the fire, but the insurance claim pays them 500 million. So instead of going from losing money, they went from 150 to 150. The insurance worked really well. So you as a stockholder, wow, you're glad they had the insurance. But now we go over to Chubb. Well, Chubb, their revenue went up 50 million because they got the insurance. But now look at their expenses. They have underwriting, they have policy service, and now they have the adjusters. The adjusters to pay the claim. So their expenses went up even more. It's not just 20 million, it's now 50 million. Again, that's too high, so use more realistic numbers. And then they have to pay this claim, 500 million. So, this is what I call this left pocket, from an investor standpoint, left pocket, right pocket. So, your stock portfolio, you can't possibly come out ahead on this because you have the insurance company in your portfolio. So, and now look at your expense leakage. Now let's think about this up here. If we had with the loss, without insurance, what would have happened? Well, you've had 200 million minus 500. They would have lost 300. There's no difference there. If you add that across, you would have been down 200 million in your portfolio. But now you look at it, you're down 250. Where did that 50 million come from? Why are you off? Just because all they did was buy insurance, why is it you as a stockholder, stock investor, why is it that your portfolio's earnings are 250 loss instead of 200? With the insurance, without a loss, you're off by 20. With the insurance and with a loss, you're worse off by 50. Why is it? It's the expenses that Chubb, as the insurance company, has to pay to employees, adjusters, policy server, underwriters. It's those expenses that are essentially leaking out of your portfolio and are harming you. So my argument is, even when Chubb might be insuring something that, in this case, it's an unsystematic risk, it's a warehouse fire, but if it was directors and officers insurance or anything else that could be systematic, it still doesn't matter. There's no way your portfolio will come out ahead. Because Chubb is a publicly traded company. There's a lot of publicly traded companies like Progressive and Geico that do this type of insurance, and they're insuring other companies that are in your portfolio. There's just no way you're going to come out ahead. So that's the expense leakage that you need to make sure you explain it, and it's also explains why this left pocket, right pocket, it's not a wash. The $500 million that Chubb pays doesn't get offset by Toys R Us getting higher because of the expenses the insurance companies have, and the insurance company expenses are pretty significant. Usually 25–30% of premiums is going into expenses. That's what a typical expense ratio is. So a big chunk of the money that any company in your portfolio is spending insurance for, when they take that and that becomes a revenue of another company in your portfolio, 20–30% of that is going to disappear because you're going to have to pay salaries to all these extra workers that other companies don't have. So those are the arguments. So we just did the income statement example, expense leakage. So essentially what we're saying, we do not want management spending precious corporate resources to mitigate a risk that you, the investor, have already mitigated simply by diversifying your portfolio. Now, I want you to be real careful on the exam. Be careful, when are you talking about management and when are you talking about the investor? A lot of students get confused on this question. They say management has already mitigated this risk with diversification. Management has not diversified this risk, and in fact management still has this risk. Management is not well diversified. They're the CEO of this company. If this company has a large loss, they will definitely feel the pain of that, even though the stockholder might not notice it so much because it's only 2% of their portfolio. Management will notice it. So be real careful. We do not want management of the firm spending resources to mitigate these risks buying insurance, because the investor is well diversified and they've mitigated that risk. Or the investor is going to experience the expense leakage. All right, so be real careful. Are you talking about management or are you talking about the investor? So I'm real picky on the exam. If you say you or they, you need to tell me who the you is, who the they is. Is it management or is it the stockholder? All right. If you're not clear of that, write that down as a question to talk about when we have our online in-class sessions. Make sure you're really clear on that, or send me your answer to that question and call me. We can walk through your answer and make sure you're real clear on that. Some students get real frustrated with me because I'm so picky on the answer, and they say, well, I kind of said it, but the reason I'm so picky is I want to make sure you really understand this. The capital asset pricing model is speaking specifically about the investor and their risk, not management, not society. I mean, it's talking specifically about the investor, the stockholder. All right, so according to the theory of finance, companies should not be buying insurance. Corporations should not be buying insurance. Individuals should. We just talked about insurance makes a lot of sense for those low frequency, high severity events. But for corporations, it doesn't make sense, just because of those two issues, the capital asset pricing model and the fact that the insurance company and the insurer are both in your portfolio. However, companies do buy a lot of insurance. So why is that? So in the exam, I want you to give me 2 or 3 of these. You know, if you give me 2 and talk about it in a lot of depth, you might get more points than give me 3 and it's too high level. So, you know, make sure you give me a good solid answer. But I'll give you a few reasons. I'll give you 6 reasons here. But reason number 1 is, I think the most important one, is the one I really think you should all put into your answer, and it's really a few pieces here. But the first reason is that there are other stakeholders besides stockholders for whom capital asset pricing model does not apply. So let's start with one group of stakeholders, and that's the lenders. So we just looked at Toys R Us. Toys R Us has stockholders, but they also have bondholders, people who have loaned them money. And the capital asset pricing model doesn't really apply to bondholders. Because remember, with stocks, if you have bad news at one company, it's offset with good news at another company. But that's because as a stockholder, you have unlimited upside. So you have a 20% loss at one company, you might have a 30-40% gain at another company. With bonds, that is not true. With bondholders, they have the downside. If Toys R Us goes insolvent because of a warehouse fire, they have that loss. But with bonds, there's no big upside anywhere else. With a bond, the most you can make is the coupon on the bond. So you can't offset it with another bond somewhere else. So diversification doesn't quite work. Losses on bonds harm the portfolio because there's no offsetting big gain on the other side. So it's a very skewed. Stockholders tend to be skewed on the positive side. There's no limit to how high you can go on the stock. We saw Zoom last year jumping up hundreds of percents. I think Spotify is up a few 100% or whatever. So you have a lot of upside. The downside's 100%. The most you can lose on a stock is 100%. But with bonds, you can lose 100% on bonds, but the most you can make is that 5-6% coupon. The second one is employees. Employees of the company cannot eliminate their unsystematic risk. They're working for one company. Now, they can go get a job somewhere else, but they don't want the management of the firm failing to manage the risk, and suddenly they're out of a job because the company didn't buy insurance. And then a special group of employees is senior management. Senior management especially has a very non-diversified exposure to this company. They're getting paid, you know, 7-digit salary to manage this firm, and if this firm goes under, they're going to lose their job, and they may not be able to get another job that pays as well, mainly because they were just managing a firm that went insolvent. That's probably going to make it difficult for them to find another job. So they have an incentive to manage their own personal risk, even though their stockholders are saying manage our risk. That's part of the agency problem that we have. You probably heard about the agency problem in your 3013 class. Management is not just seeking to manage the risk of its stockholders, because management has their own personal risks. So stockholders try to get management's incentive lined up so they align with the stockholder, but there's just no perfect way to do that. Management has risks that are not diversified away because of the capital asset pricing model, because of diversification, because management doesn't have that diversification. So management will tend to be more risk intolerant, more conservative than the stockholder, or at least the theories might imply that they should. So the agency problem, they try to control this by having management hold a larger amount of the company's stock. But the problem of that is it just makes them more exposed to the company and makes them want to take less unsystematic risk at the company. So you can see those ways we try to align management to the stockholder actually makes management more concerned about unsystematic risk. So it's a strange problem. There's been several articles and books written about how do you solve this agency problem, how do you align management with the stockholder, and this is the one area where most things you can do that do align management with stockholders. This is the one area that it almost always exposes management more and more to unsystematic risk. And because of this theory in finance, the capital asset pricing model, That's one area you're probably always going to have some disconnect between the incentives of management and the incentives of the stockholders. It's an interesting problem, really tough problem to solve. There's another group, vendors. Vendors, they don't want to have exposure to a company that can't pay its bills. And some of them may actually require the company to have insurance. I know at UTSA, anytime we had a major vendor contract, the vendor had to provide us a certification of insurance and prove that they were insured. If their employees were going to drive on our campus, or anything that might have that kind of risk, they had to prove they had the insurance before we would do business with them. And then the last group is regulators. Regulators, they do not want a company going insolvent on their watch, so they want management managing those unsystematic risks, because regulators look bad when a company goes under. Regulators don't care about the stockholders. They're worried about making sure companies do well under their watch. So you can see there's a lot under this other stakeholders. It's an important one, and it's really multiple. That's why I say you could do 2 on an exam and get credit for doing 3 if you really get into this one, because there's a lot here. The second reason corporations buy insurance, even though the theory says they shouldn't, is that insurance companies do more than just pay claims. Insurers have other activities that actually make companies operate better. They're really good. Insurers are really good at loss control. So if you think about a cost-benefit analysis problem that you had in some of your finance classes, insurance companies tend to be really good at that. So the insurance company might show a company they're insuring, hey, if you would do these activities, it won't cost you much extra money, but it can certainly save you a lot of money on your insurance, also save you the exposure to the loss. So you spend $5 million doing this, but on average it's going to save you $10 million, then yeah, that's good. The insurance company shows a firm how better to manage overall risk in such a way that what they're spending to manage that risk is actually cheaper than the actual expected loss. And so yeah, it makes the firm more efficient. And insurance companies are very, very good at that. We'll talk about some special type of insurance like boiler and machinery and insurance, where insurance companies really, really help firms manage their business better because of their expertise in those areas. Another reason corporations buy insurance, even though the theory says not to, is that it's essentially an outsourcing function. The insurance company does certain things better than the employer, than the company. And so you use that insurance contract to outsource. I saw this at UTSA. UTSA had a workers' comp insurance policy, and UTSA could have hired employees to handle workers' comp type of claims, when an employee gets injured. But that's not UTSA's expertise. So rather than having 2 or 3 full-time people doing that, they use their workers' comp insurance company, and that insurance company handled those claims, handled dealing with those employees, and they wouldn't have to hire 2 or 3 full-time people because they're handling a lot of clients. They can handle it. It gives them good economies of scale. So claims administration, it's somewhat of it doesn't offset the entire insurance premium, but it can certainly offset a good chunk. So that $15 million or that $20 million we saw that Chubb was spending, we might actually go back to Toys R Us and maybe their expenses go down $5 million, because part of that $20 million that Chubb is doing is stuff that Toys R Us would have to do if they did not buy, and if they did not buy the insurance. So it helps offset not all of the insurance premium, but probably a sizable part of it. Another reason firms buy insurance, especially smaller firms or new firms, is it gives you somewhat of confidence in the firm. If an insurance company is willing to insure this company, then others are going to be willing to do business with them. I know I started a small consulting firm for a few years, did one big project and then shut it down. It was just too much work and too much time. But one of the things we saw in starting this business was buying a liability insurance. And it was expensive. We had a big debate. Do we buy this insurance? Because it's a few $1,000s. It's, how much business we had. But if we were going to do business showing them that we had this insurance, that we had a legitimate business plan. We presented to an insurance company. They're going to do the review. They're going to insure us. That gave them some confidence that they could do business with us. Another reason firms buy insurance, even when the theory says not to, is taxes. And we'll see that later when we especially talk about captive insurance companies. There's a lot of insurance that the only reason it's bought is for tax reasons. That's not entirely the case here with property insurance, but taxes is a big part of this. And this is a little bit hard to explain. You'll notice in the Chubb Toys R Us example, I did not have taxes in there. But the way the IRS allows insurance companies to do reserves, insurance companies get a tax benefit well before the loss actually happens. So with Toys R Us, if you go back to the example, that $500 million loss for Toys R Us will not be able to take the tax deduction for that loss until that loss happens. And if you have a $500 million loss, that might be more than you owe in taxes, more than your income. And so this year your tax goes to zero, and then you have these losses. You can carry them back, but you may not have enough income to carry it back, and so you may not be able to get the entire tax deduction all at once. And so there's a limit to how much tax benefit you can get from that $500 million loss. With insurance, the insurance company gets to take that $500 million, and the way the tax laws works, they essentially get to spread it out over time, so they get to move that tax deduction earlier. It's hard to explain, but it's just the way insurance companies are taxed. They're one of the most, or they may be the most complicated taxable entity in the U.S. The tax code for insurance companies is quite complex. But if you really look at it, insurance companies do get an advantage tax-wise that companies do not get because of the way their reserves work. The last one is firms that are heavily regulated. Utilities are a good example. It's cost plus pricing. So if it's cost plus pricing, buying insurance just becomes a cost that you get to add on to your rate base. And so regulators let you charge more for your product because you have this expense for insurance. So essentially your stockholders, here's one where the stockholders actually still come out ahead. So you've got costs. It's kind of the problem with utilities that their incentive to control their costs is not all that great because the regulators let them get their cost plus a profit. But if they buy insurance, that's part of their cost. They get to add a profit on top of that, and so it's not really harming the stockholders or the company. Essentially, they're getting to pass that insurance costs onto their rate base, onto their customers. All right, so those are the reasons. You don't have to talk about all of them, although I might actually on the exam, given the way the exam works now with COVID-19, I might actually ask for more of these than I normally do. But it's a good theory. I think it's a great way to understand the capital asset pricing model, understand agency theory, and really see how these theories work together, and then look in real life and see in real life, because of these agency problems, firms don't always do exactly what is the most economical, like the theory would say. All right, so that's that second question. So the first question is when should individuals buy insurance? And we say that makes sense for low frequency, high severity events. The second question is, should corporations buy insurance? And what we said, theoretically, no, they shouldn't, because capital asset pricing model says you shouldn't spend money to eliminate unsystematic risks that the stockholders already eliminated. And even if the risk is systematic, it's just a left pocket, right pocket transaction that you come out behind because of the expenses of the insurance company. But however, corporations do buy insurance, and we had these 6 reasons for why they do. So what is the last question? Our third question is, when should insurance companies write insurance? And we'll use this term quite a bit. I use it without even thinking. Writing insurance is just, think of the word write as sell. When can insurance companies sell insurance? And this has a high overlap. You'll see a lot here closely related to what you're doing in paper 1. So see if you can see these overlaps. So there's there's four things that need to be in place. So another way to think of this is characteristics of losses. Probably the best way to think about it. What type of things can insurance companies cover? So a good example, 2020, we had COVID-19. A lot of businesses had to shut down. Insurance has a policy for business interruption, and there's a big debate. You could even make this your paper for this semester, that second paper where you get to pick your topic. So business interruption insurance, should that cover something like COVID-19? So let's look and see at these characteristics and see if COVID-19 is a risk the insurance industry should cover. So the first thing, very much out of the paper one, is an insurance company must have the ability to evaluate the risk. That is, they should be able to figure out the frequency and severity of the risk in a way that they can price it. Some are quite easy. Life insurance, we have a pretty good idea when people are going to die, but COVID-19 has definitely impacted that. I think I saw an article, can't remember the numbers, but an article in The Economist that COVID-19 is going to reduce life expectancy by about 1 year. That's how big of an impact COVID-19 is going to do. It's going to take 1 year off the average life. That doesn't mean everyone will live 1 year later, shorter, but enough people had 5, 10, 15, 20 years cut off of their life that the overall mortality table is going to see 1 year cut off of life. That's pretty material. But for the most part, life insurance is pretty predictable. Car insurance, pretty easy on car insurance as well. We have a pretty good idea of how many wrecks a 22-year-old is going to have, how many wrecks a married 35-year-old is going to have, how many wrecks a married 35-year-old man's going to have versus the 35-year-old married woman's going to have. But it gets a little tricky. Speed limits might change. More SUVs are driven. Fewer SUVs are driven because oil prices go up. This last year with COVID-19, that had a huge impact on the car insurance because people were driving so little in April, May, March, April, May, June, July, and even to today, although it's definitely picked up. I can tell as I do my daily bike ride, I can tell traffic has definitely picked up dramatically in the last 8 months. But last year, car insurers saw a huge drop in claims because so few people were driving because of the stay-at-home orders. And my insurance company actually paid me a special dividend, reduced my insurance rates because of that. But for the most part, car insurance is pretty predictable. Home insurance is pretty predictable as well. We kind of know how many fires there's going to be, winter storms, those kind of things are pretty predictable. However, as we talked about in paper one, global warming may be changing that, so that maybe that's going to get more difficult. But these tend to be the more straightforward. Some risks are very, very specialized. We'll talk about that with boiler and machinery, where only a very few insurance companies cover this risk. So if you're an actuarial science major, this might be an area to think about. I think there could be some advantage to really specializing in the actuarial science side, especially these days when it's getting a little tricky. The industry tends to have extra capacity, especially on the life insurance side. Specializing might make sense in a place like boiling machinery that will probably be around for 50, 60 years, probably not going away. You specialize, it could make some sense, but very specialized. Not every company can do this because understanding the frequency and severity, you need a lot of data. If you haven't been selling this product for years and years and years, you probably can't just jump into it. And there's some, like we talked about with paper one, there's some that is just almost impossible. Terrorism risk, cyber risk. That's a great article for paper two, cyber risk in the insurance industry. Flood, the insurance industry does not cover flood, and we'll talk about later why it does not cover flood. Earthquake, the insurance industry does cover earthquake, but with very, very high deductibles, just because we just don't have much data. And again, global warming is making the flood side especially more difficult. Earthquake, we know there's going to be the big one in California, We don't know if it'll be next year or in 100 years, but eventually there's going to be a huge series of losses there. So just remember from paper one, there's some risk that are hard to insure because of limited data, and there's some that are hard to insure because of changing distributions. Make sure you have that in your paper one. Very important. That's the most missed part of paper one. I could say and or. It could be both. So terrorism risk, limited data, and we may have changing distributions. Flood risk, not limited data, but definitely changing distributions with global warming. So it makes it very difficult to insure those risks. And you'll notice the insurance industry is definitely moving out of these products and trying to avoid them. Now that's where I got into, Berkshire Hathaway on the terrorism risk. That last paragraph we talked about on that 2001 write-up. Is he really avoiding that or not? So it's an interesting question. But that's the first one, very much out of paper one. Number two is not in paper one, but number two says a loss. It must be obvious that a loss has happened. So for life insurance, first of all, for life insurance, it's a valued policy. What that means is you tell the insurance company how much money you want if you die, how much money you want going to your beneficiaries if you die. What we don't want with life insurance, if you die and now the insurance company has to figure out how much your life is worth. They're going to insure the present value of your future earnings, and you die, and now there's this big debate of, your heirs are saying, no, he was going to get a big promotion, he was going to get all these raises, he was going to go back to school and get these new skills, so his life was worth $500,000, and the life insurance is saying, no, he was going to quit his job, he didn't like it, he's only worth $200,000. So it's a valued policy. So when you die, all the insurance company needs is a death certificate, and once they get that, and there's no obvious, kind of foul play going on, then they're just going to pay you whatever the policy says. Very straightforward. For auto, home, health, you have to file a claim and have evidence of a claim. So for auto and home, if your car got stolen, you may need a police report, or if your home got robbed, a police report, or bills from mechanics or from hospitals. And this type of insurance is indemnity insurance. So they're going to say, how much did you lose, and we'll pay you that. But we still want to keep it out of the courts. We don't want big debates. And so you file a claim, you have evidence of the loss. Usually you'll file the claim before you get, for auto and home, you'll file the claim before you actually contract with the whoever's going to fix your house or your car. And in some cases, the auto insurance will actually tell you which vendors they prefer you to use. So in that case, before you go in and talk to a mechanic, you want to make sure you're covered. With hospitals, we won't get into that here, but in my life insurance class, we had a big debate about surprise bills and how horrible that industry is. And just, people getting these $100,000 bills that they thought insurance covered but didn't cover because it wasn't part of their plan. And just, so health insurance is the really boogeyman in this whole thing. Really, health insurance, in this whole thing, health insurance is the one that violates this list more than anything else. So for indemnity insurance, we got to make sure that we've had a claim because the insured provides the evidence of that claim. All right. So we're trying to keep everything out of the courts. So everything doesn't get expensive. There are a lot of auto claims that do go to court, but we're trying to minimize that as much as possible. And we'll talk about that more when we talk about Part A of auto insurance, the liability side, and this whole issue of no-fault insurance. The next one is definitely part of paper one. So number one and number three are very definitely part of paper one. And what we're trying to do here is insurers need to be able to control their exposure to non-accidental events. They need to be in the insure things that are fortuitous and accidental. So Warren Buffett talked about the moral hazard. You shouldn't insure people who are unethical. They're going to file fraudulent claims. You also have the moral hazard. Moral hazard is legal. Moral hazard is illegal. So moral hazard is people file an illegal. They actually intentionally burn down a house so that they can get the insurance. You know, arson. That's illegal. You cannot do that. That's a moral hazard. What insurers do there is they just don't pay the claim. They just refuse to pay the claim, and their policy says that they can do that. So moral hazard is people act differently simply because they have the insurance. They become more risky because they have the insurance. So for me, the easiest way to explain that is with auto insurance. So let's say you go out and you buy your first Ferrari. And let's say you spend $130,000 on a Ferrari. You're all excited about it. You get to the dealership. You're sitting in the car. You're about to drive out, and you go, "Oh my word! I forgot to buy auto insurance. I got this car. I leveraged myself. I borrowed all this money. I really can't afford this car, but I really want to impress my friends. But now I just realized I don't have auto insurance." So you have to think about how are you going to drive home with that Ferrari? You might be driving 20 miles an hour, and if you see any car, maybe you wait until 3 a.m. to drive home. You sit there at the auto car dealership, and you wait until 3 a.m. and then you slowly drive home. If you see another car on the road, you pull off and park just in case that's a drunk driver or someone not paying attention. You get home, you put the car in the garage, you close and lock the garage, and you sleep in the car just in case someone comes in, you know, and you're actually worried about your house catching on fire or anything else going on. So you sleep in the car and you have a fire extinguisher right next to it. The next day, you call your insurer, you insure the car, you make sure you're insured. You're probably become a much riskier driver at that point. Once you have the insurance, you know you're covered. And that's what we mean by moral hazard. The second you get that insurance, you become a riskier driver. Insurance companies know this, and because they know this, they're actually going to charge you more for the insurance because you bought the insurance. And I know that seems like a circular argument, but the simple fact that you bought the insurance makes you a riskier driver according to their models. And so they're going to charge you an extra 10, 15% because they know you're going to be a riskier driver because you now have insurance. Now, auto insurance, it works well. I don't know about health insurance. I can't think of people who say, you know, I would go bungee jumping and do more skydiving if I had insurance, but I don't have health insurance, so I'm not going to do that. I can't imagine. You have a lot more skin in the game personally. Life insurance, probably not. I don't know people who say, "Wow, I'm not gonna do that skydiving because I don't have life insurance." You know, that just to me seems a little bit too extreme. Maybe there's someone who's thought that before. Homeowners, a little harder to think about as well. Mainly because on homeowners, we don't tend to do risk. You know, we tend to really not want to lose our homes. So to say, you know, I'm going to leave the oven going even though I'm traveling because I have a fire, I have homeowners insurance, no big deal. Because we lose so much when we lose a home. We have a lot of personal. Losing a car, you know, that's personal, but we don't have, you know, all of our photos and our keepsakes and all those things in our home that we would really lose. I hate to lose. So I think auto really fits the best on a moral hazard. Homeowners definitely fits on a moral hazard. There are people who have fraudulent claims. Now, for life insurance and health insurance, the bigger issue here is adverse selection. It might apply to auto insurance as well, but adverse selection. What adverse selection means is people who need the insurance are more likely to buy it. So a little different moral hazard. Moral hazard, the insurance changes our behavior. With adverse selection, our behavior changes how much insurance we want to buy. So if we're risky, we want to buy a lot of insurance. If we're unhealthy, if we got terminal illness, we're more likely to buy insurance because we really need it. What insurance companies do here, like for moral hazard, what insurance companies do, they just charge you more for the insurance. With adverse selection, what they do here is they underwrite the policy. So they figure out, hey, if you're a smoker, we're going to charge you more for the insurance. What's your avocation? So if you're doing bungee jumping, if you're doing skydiving every week, we're going to charge you more for that. They have select and ultimate tables. Select tables, what that means is people who have just recently gotten a medical exam, we'll give them a lower premium than people who haven't been to the doctor in 5 or 6 years. So that's how life insurers handle that. They underwrite it, they look at it, they charge riskier people more than low risk people. Annuities, healthy people are going to buy an annuity because annuity pays you an income for the rest of your life. So if you live a long time, you get a much more of an annuity. So insurance companies know this, that healthy people are more likely to buy annuities than unhealthy people. They don't really underwrite it. They just charge more for annuities than they would for life insurance. Autos, bad drivers are more likely to want coverage than good drivers. We'll talk about this market for lemons here a little bit later in the class. And what that says is we know it really, market for lemons, just real quickly, is hopefully you had this. I read this article in my auditing class when I was an accounting major. I'm not sure what other class you would have it. It's a pretty important article. I don't recommend that you read it because it's a really boring article, but the concept is really important. So you could probably type in market for lemons and find it on Wikipedia, a really good summary. But essentially what it says is used car salesmen have a bad reputation. And because of that, when people go to buy a used car, they're going to be skittish and they're not going to pay the right amount for the car. And because of that, really good used car salespeople, they're going to see that they're not getting the right price for their cars, and they're going to go out of business, and that's going to cause the average market for used cars to get worse, and that's going to cause a spiraling down. It's the same thing with auto insurance. Bad drivers are going to want coverage. That's going to jack up the price of auto insurance. That's going to mean good drivers are going to say, you know what, I'm a good driver, I'm paying too much, I'm going to stop buying auto insurance. That's going to cause a problem of mushroom. You get the spiraling problem. So auto insurers, the way they have to do this is they need to underwrite their drivers. And we'll talk about this in detail when we talk about credit scores and why credit scores influence insurance rates. But what auto insurers are saying is we have to underwrite our drivers. We have to charge riskier drivers more. Otherwise, the market will just spiral out of control. But we'll get into that more later, but it's definitely there. So underwriting helps. You have medical exams, you have questionnaires, you look at driver's records. We're going to talk about credit scores. So you either deny coverage or you charge more. You rate the policy. That's what underwriting is all about, is you rate the policy. Riskier people get charged more than low-risk people. Now, one way you control adverse selection is you make sure the person buying the insurance has insurable interest. What that means is they would much rather not have a claim than have a claim even after considering the insurance. That's what I was talking about with homeowners insurance. I doubt people are going to be riskier just because they have homeowners insurance, mainly because most people don't want their house to burn down. There's just, even though they're going to get a brand new house from the insurance, they still prefer that not happen. It's just a painful thing to go through. Life insurance, obviously we'd rather live than die, even though dying means the insurance company is going to pay us a lot of money. Not that, you know, you've read Death of the Salesman, if you remember reading that book in high school, and Loman, you know, commits suicide because he was such a failure in life. He thought commit suicide so his family would get the life insurance, and then discovered that he committed suicide during the suicide exclusion period, and so he didn't even get that. So, you know, it's a really horrible play, pretty depressing, but it was an insurable interest type of issue. Now, for life insurance, you can insure your own life. You can always have insurable interest in your own life. So as long as you're insuring yourself, there's no issue. and that insurable interest lasts the entire policy. So if you're buying insurance on your spouse's life, once you set up the policy, you have insurable interest until your spouse dies, even if you got divorced. Life insurance is a special case. But for most insurance, other than life insurance, insurable interest has to be there all the time. So if you buy auto insurance on your car and then you sell that car to your neighbor's 16-year-old kid, you can't tell your neighbor, hey, you know what, I'll just keep buying the insurance, paying for the insurance, and you can reimburse me and you'll have insurance on this car. No, once you sell that car to your 16-year-old neighbor, that insurance cancels. If you keep paying the premiums and then that kid has a wreck and you file a claim, they're going to say, no, here's your premiums back. We're not covering that loss. We were insuring you. We weren't insuring your 16-year-old neighbor. So insurable interest is an important way insurers cover this. So question 3 has some relation to paper 1, not as much as I was thinking when I started this, but it has some relationship. The 4th thing, definitely, this one I'm absolutely sure is very closely related to paper 1, is you can only insure those events that are not going to destroy the insurance industry. This is what Warren Buffett was talking about, those extreme tail events that are just so expensive they would just destroy the industry. So flood is one of those where flood can hit a very wide area all at once. So if you're insuring houses and you have this really big flood, you can really destroy a lot of houses. War risk for life insurance. Most life insurance excludes war risks. If someone joins the military and is put into combat and they die, the life insurance company is not going to pay that claim because they died in war. War related to property risk is not covered. If you read your insurance policy, war risk is not covered. It's one of those exclusions. That's why in 9/11, back in 2001, when President Bush said, this is a war on terror, there were some people debating insurance companies that were paying these massive losses after 9/11, for workers' comp and for the buildings that got destroyed. Well, while President Bush said this is a war on terror, that's war. War is excluded. Now, I don't think anyone got the war exclusion. 9/11 was not considered to be war that was excluded by insurance, but there was that discussion. So war, nuclear bomb, if your house is destroyed because of a nuclear bomb attack, your homeowner's insurance will not cover that. Terrorism risk, some policies are excluding that. There's been a lot of action at the federal government side to try to make sure insurers cover that risk. Earthquake and hurricane risk, they're definitely covered, but there's been a lot of debate of can insurers continue to cover these risks, at least in California for earthquake risk, or in Florida and Texas for hurricane risk, and the East Coast. There has been some debate that hurricane risk might be a lot like flood risk. It's gotten so big, so massive, especially with global warming, that the industry may just not be able to cover these risks. So very close related to paper 1. So yeah, there's a lot of overlap here. All right, so we've covered those 3 questions, 3 very important questions to your understanding of insurance. Make sure you understand these when you're going into an interview with an insurance company, because boy, they're quite important as far as conceptual understanding of the industry. All right, so now what we want to do is get to the overview of this industry. Just a quick overview. We'll do this here for a few minutes, and then we'll probably just move over into the next class as well. But insurance is part of a sector known as financial services. I forget how many sectors there are because Standard & Poor's changed it. It's 10, 11, or 12. I can't remember. They actually broke out a new sector called communication services. They moved the telecoms in there like AT&T, and then they also moved Google and Facebook. Those type of firms. So it's an interesting, there's some tech in there and telecom in there. So I'm not sure how many sectors there are, but it's 10, 11, or 12 sectors. Financial services is one of those sectors, and it's one of the largest. It's not the largest right now. Technology is still the largest, although they pulled out some pretty large tech firms and moved them to this new sector. And it changes. Financial services has been the largest at one time, and then it sold off dramatically. Energy was the largest at one time, and then energy companies sold off. Tech was really the largest in 1999, and then we had a 2000 dot-com bust. So it is actually kind of dangerous to be the largest sector. Usually when a sector becomes more than 30% of the stock market, there's usually a major sell-off in that sector. And financials were over 30% at one time when we had a major sell-off in that industry. But right now, financial services, I think it's maybe 20% of the stock market. Within financial services, you have the major groups are banks, investment, real estate, and insurance. Now, I think actually, and this may be why there's 13 sectors, I think real estate has actually been moved to its own sector, and it's, I think, the smallest sector in the entire market. So yeah, this changes over time. It's not always the same, but banks, investment, and insurance are definitely part of the financial services sector. Now that's a sector. These are industries, but these are larger industry groups. So you can break out these industries. So banks, you can break out banks into community banks, money center banks, regional banks. So insurance, how can you break up insurance? Well, insurance, you break them up into life, health, and annuity, property, casualty, and probably other. There's probably some other. Title insurance. We'll talk some about title insurance a bit later. One student did a paper on title insurance, which would be an interesting paper again. I'd be interested to see that again. He did a pretty good job of covering that topic, but title insurance might be a separate area. But we're going to break it between life, annuity, health, and property and casualty. Within life, annuity, and health, we think about individual and group. Now, these are not different industries. This is as far down as we go in the industry, but within this industry, there's individual and group. Most major insurance companies do both individual and group insurance. Like at USAA, USAA does mainly individual insurance, but they did a little bit of group insurance because they did the group life insurance for the USAA employees. So that was the one group type of insurance that they did. So for property and casualty, they break it between personal lines and commercial lines. So we're in this industry here, so let's really get into this. So the customer is either personal lines or commercial lines. We're going to talk about both of these. My background is much more on the personal lines. So you'll notice when we get the commercial lines, we'll go a little faster, partly because there's a lot of overlap with the personal lines, but also I just don't have the industry experience on the commercial side, so I can't help you quite as much there. So then they break it between property insurance, liability insurance, worker comp, and other. And I think title might be its own industry. I just don't know, but other. So on property, we have auto, home, and other. And we'll be getting into these in detail. Liability are also known as casualty. There's auto liability, home liability, other. And then we'll talk about these special types of medical malpractice and product liability. I mentioned D&O and others, so there's others in there. Workers' comp, we'll spend a little time on workers' comp, and we'll talk a little bit about title insurance. But that's how the industry is made up. If you're an actuary, you'll be on the life side, the property and casualty side, or the benefit side. Or if you're an actuary major and you can't find a job in actuary, then you just take a job in decision science and you're fine. There's so many places you can go with the math skills you get as an actuary, so you're in good shape. But right now, there's more jobs on the property and casualty side, but the life and health, there's some advantages there. We may talk about why you might pick life and health over property and casualty as an actuary. So, or if you won't, just call me if you're an actuary science major, and I can definitely give you my feedback. I'm not an actuary, but I worked a lot with actuaries. So if you're an actuarial science major, yeah, feel free to call me to talk careers. And if I can't help you, I can probably find an actuary in the business who'll be willing to talk to you one-on-one. All right, so that's it for today. Next class, we'll talk about, this is where we'll get into some of this a little bit more specifically to property and casualty side. So we'll talk about jobs and insurance.